Good morning. I want to trust that we are well this morning and that you're continuing well. We are coming to the end of the semester. Therefore, it is important for us to start winding up the journey that we started a few weeks ago. So far, so good. And I want to trust that all things are working out together for us. But today, our focus will be on audit investigations. We're going to learn about audit investigations. And we want to be able to explain and carry out audit investigation. We want to be able to discuss various issues, including receivership. And we want to also learn about the difference between audit and investigations. Now, an investigation can be defined as an inquiry commissioned by a client for some purpose. We can define an investigation as an inquiry that is commissioned by a client for some purpose of his or her. The scope of inquiry would range and the range of possible clients and the number of purposes can be very large, and therefore the scope can be enormous. And therefore, for the purpose of this lesson, and the purpose of this unit, we shall confine ourselves. We shall confine ourselves to the most common type of investigations that professional accountants may be called upon to do. That will be our focus. And probably before we look at the different types of, or the common types of investigations, it is important that we are able to differentiate auditing from investigation. And while auditing entails the examination of books of accounts and vouchers of our business with a view of proving the true and fair view, investigations, on the other hand, entail searching and inquiry into company affairs. It is a searching inquiry into a company affairs. Auditing covers one financial period in normal sense of business continuity, while investigation, on the other side, may cover more than one financial period. It may cover more than one financial period, maybe a period of 10 years, 20 years, depending with the reason for inquiry and the timelines that are given. Thirdly, it is auditing is conducted for the owners of the business. It is conducted for the owners of the business, while auditing, on the other hand, is usually conducted. It is usually conducted on behalf of the outsiders. On behalf of the outsiders, for example, we may talk about government for the purposes of taxation, investors, or even the general public. Good, an investigation and an audit also is usually restricted to the books of accounts. That is the main focus. Investigation, on the other hand, is not restricted to any area, although the focal point will be where there are susceptible cases of fraud, where they are susceptible to fraud. Another one is that the auditing is conducted to prove the true and fair view. Investigation is conducted to investigate the extent of a fraud. It is therefore an incidental objective of audit. Auditing also is conducted by a competent professional, while investigation is conducted by a qualified, a competent professional who may be a lawyer, a tax assessor, etc. On the other hand, we also say that auditing is conducted without suspicion, right? You're going there with sober mind, it's no suspicion. Whereas on the other side, investigation is conducted where there is suspicion of fraud, and therefore that is the main focus. Suspicion must be there. Another difference is that an audit is a requirement of the Companies Act. Is a requirement of Companies Act, which is mandatory for limited companies. An investigation is not a requirement of the Act and can only be necessitated by the prevailing circumstances in an organization. The other one is that in auditing, an auditor can be prosecuted for professional misconduct, and as such, he has to observe what we call professional ethics in an investigation. On the other hand, investigators are not governed by any act. They are not governed by any act. We'll need to take a short break, then we continue. We look at the types, most common types of investigations. And here we have different types which are common that are done by professional accountants. One, we have what we call acquisition of company, investigation for the purposes of acquisition of a company. Number two, we have purchase of business. Number three, we have prospective investments. Number four, we have admission of new partners. Number five, we have prospective lending. Number seven, we have fraud. Number eight, we have system breakdown. And number nine, we have company acts investigations. Now, we shall also be looking at the prospectus and the profit forecast for business. And it is important to remember that investigations may be needed whenever facts are in doubt or in dispute or where knowledge is required. Anybody can commission an investigation, and many times you'll find that companies, individuals, financial institutions, and banks, and also tax authorities can all commission various types of investigations. Now, what are the stages that are involved in an investigation? What are the stages that are involved in an investigation? What stages are there? It is important for us to look at the possible stages that will be followed, those processes that will be followed for the investigation to take place. Now, all investigations are carried out in the same way. And therefore, it is important for us to bear this in mind, that no investigation is different. All the processes and stages are the same. So stage number one is written instructions. Stage number one will be on written instructions. And here you must always obtain precise written instructions from a client. You cannot just start investigation without a written, precise, which means you've been told the purpose of investigation from the client. This must incorporate a very clear view of the aim of investigation. It must also give us the scope of investigation, the degree of the details that is required, right? And the degree of the secrecy to be observed, right? All those things must be incorporated. All things that the accountant or the investigator needs to address in his report must be included in the written instructions. And at this level, consideration must be given to the resources the client is ready to utilize and the cost of the job, both in terms of money and in terms of time. That is stage one. You see that stage one is about written instructions. Stage number two is what we call professional courtesies. Professional courtesies. And professional etiquette requires that an investigations, that if the investigations are carried out in the affairs of an organization to which the accountant is not the auditor, or to which the investigator is not the auditor, then the auditors must be communicated with. So that if you're sent to go and carry out an investigation in company A and you are not the auditor of that company, you must be able to communicate with the current auditor, right? And this is a matter of courtesy, and also a way of seeking their cooperation, because there are issues that would be more evident and would be easier to get if they cooperate with you as an investigator. Stage number three is on organization of investigations. Organization of investigations. And this involves the accountant assessing the aim of the investigation, estimating the time to be taken, and the likely cost. And also ensuring that the appropriate staff will be available. We are organizing, and therefore we must be able to assess the aims, assess the time that we are likely to take, assess the costs that are likely to come in, and also allocate appropriate staff. Stage number four is the obtaining the background information. Stage number four is on the background information. And this is very, very, very important, and especially in investigations in acquisition of a business. It will involve gathering as much background information as possible about the object of the investigation, the size of the industry, the structure, history since the commencement of the business, future prospects, current performance, relevant legislation affecting that industry, investment information, relevant accounting ratios also need to be calculated here. And this information is usually available from published sources, such as government statistics. We have trade associations. We have the past financial statements of the company. They'll give us a lot of background information. And therefore, stage number four, we obtain the background information. Stage number five is the gathering of preliminary information. Now, this information has to be gathered on the subject to be investigated. And this information includes the location of the business, where is it located, what are the products that they produce. It's a different range of services. They can also calculate and know the market share of their business. Are there key personnel? What are their experiences? What are their education level? What are their skills? what are the major accounting control systems that are in place, and what past reports are there concerning the company. We gather the preliminary information. Stage number 6 is preparation of report outline. Preparation of report outline. And a report that meets the need of many accounting investigators will be prepared in a certain way, must be prepared in a certain way. And therefore, this is where you structure your report. This is where you structure your report to conform to the need of your client. So most of the reports will have these sections in them. So we'll have part A, and part A will include what we call introduction, where we have references to the instructions given. The object of the investigation must be apparent from the introduction. Then we'll have a part B, which gives a summary of the instructions that were given, a summary of the instructions that were given. Then we'll also have part C, which is a statement of the precise objective of the investigation and the report, precise objectives. We also have part D, which is a statement of the scope of investigation, stating the time period and the area that is covered or that has been covered. We also have part E, which is a statement of the documents used. If it is necessary to reproduce any of these documents, it must be attached in an appendix. It must be attached in an appendix. But in this case, we give reference to all those documents that we used to carry out our investigation. Part F is an outline of the work actually done. And again, it is necessary to put some of this material in an appendix, right? But here we give a summary. Part G is a summary of the information that has been obtained. We give a summary of the investigation that has been obtained. And part H is further information which could be of use to the client, but does not flow from the investigation proper, right? Any other information that we think could be important or vital for the client to make their decision, then must be included there. And then of course, we have what we call that is what we call an outline of the report that must be made. And that is in stage 6. It is in stage 6. It is a stage 6 that gives an outline. Then we also have stage 7. It should be part 7. Part 7 of the report. It should be part 7 of the report. Part GHI. So part I of the report, which is the recommendation of the accountant. And this is where the accountant or the investigator gives recommendations as a result of the investigation. And here the accountant or the investigator gives information from which the client can draw his own conclusion, right? You also avoid presenting information in such a way that the client judgment is influenced. You don't want to influence the decisions that they are making. And if information is based on assumptions, right, then the investigator must state the assumptions in full and substantiate them if possible, right? Because you don't want making assumptions that are not true. Then it's also important that the investigator does not make any forecasts. Your work is not to forecast that it is likely to be this way in the next 3 years. No, your work is to give facts as they appear and leave the decision to the client or the owner of the business. Now, if you're giving opinions estimates, or forecasts, then the accountant must state who made them and what qualification they had to making them. So that if you're given information by a valuer, if you're given information by a financial analyst, then you must be able to indicate that these are the assumptions that I got, and I got them from this person, and these are their qualification. And then it's also important for you to make the recommendation practical. They should be practical. They should be practical and not just theoretical. The other thing that needs to be noted on the recommendation is that the investigation must be comprehensively completed. So we are not leaving out anything. It must be in detail. It must be comprehensive, right? It must be complete. So there will be no need of carrying out any other investigation. Once the report is given, then the client must be satisfied with the report and details of the report. Of course, the report is drafted and discussed. The client must be drafted and discussed with the client. And then, of course, finally, the report is submitted. Then the report will be submitted. Now, those are some of the stages, and also the outline of the report of audit investigation. Now, we look at the specific investigations. We look at the specific investigations to sample and look at a few of them, look at what they mean and what happens when they're being carried out. We'll start with the acquisition, where interest in acquisition, interest acquisition audit, or interest acquisition audit. And the following are agreed procedures on the engagement. Now, the accountants are frequently requested by individuals or companies to investigate a business or a company of which the client is contemplating purchase, right? Let's say you want to purchase Equity Bank. You commission your auditor or the accountant to go and carry out an audit investigation on Equity Bank, and come back with a report with the purpose of buying it, because you want to buy it, right? That type of investigation is what we are calling interest acquisition audit or audit investigation. Whether you want to buy it as a whole, whether you want to acquire some stake in it, this is it. Now, what the accountant is being asked to do here is to help the client make up his mind on whether or not to buy, and if to buy, at what price, and for what consideration, right? Because you must get the estimate that this business is valued at this amount of money. Now, the accountant approach will depend on its instructions, right? Because an investigator of this nature might be carried, must be, the investigation of this nature must be carried out in strict conformity with the client's instructions, And therefore, these are some of the processes that you'll go through. One, for example, you'll obtain the written instructions, and this is to determine the purpose of the investigation and any other particular criteria that the client may wish to apply at personal level. So we must know the cash availability, the consideration to be offered, the minimum return on the investment, and the scope of the investigation. Number two is to establish contacts. The accountant must open up a relationship with the client, right? The subject of the investigation. Yeah, you must also be able to open a relationship with the professional advisors, particularly the accountants and the auditors in the client business. Number three is to examine and redraft the accounts for a period of years. You don't want to just rely on accounts that you don't know the basis of preparation, and therefore you need to redraft them, strike out odd items, right? And then check the statements for a number of years, BA3, BA1, but one would be too short to make a decision on. So take 3, take 5 years. That would give you a rough idea on what to expect in business. Now, now more than 3 years, if it is for more than 3 years, it may be very historical, right? Because performance of 5 years ago may not be replicated, it may not give us the correct picture regarding the current situation of the business, right? Of course, once you draft this account, you strike out all the recurring items and all the items which will not apply after the change of ownership. Yeah, will not apply, which will not apply after the change of ownership. And this also may involve redrafting of accounts using different accounting policies, right? Rather the one that the client has been using, for you to be able to test how rigorous they may be. Now, the other one is establishing the reliability of accounts. And now, if the accounts have been audited by a well-recognized firm, then very little verification is required, apart from considering any qualification in the auditor's report and the appropriateness of the accounting policies. Now, if the accounts have not been audited, then you require some more information. You require some more information from the company. And this may include sales, the purchases, cut-offs, work in progress and stock, gross profit ratios for the past few years and for the industry, asset evaluation, right? Valued by, of course, a competent valuer, and disclosed liabilities that may be there, right? All those must be included. It must be included. All those must be included. Let me see. The other one that you need to look at is what we call commercial consideration. You need to look at the commercial consideration. And here the various factors to be considered will include requiring the a knowledge of the spread of customer products. What is the market share? What is the market share? Knowing the development plans for the county, for the country in which the company operates. Looking at the continuity of trading agreements, right? Looking at the personnel considerations, the need for agreement that the vendor will fill in from the original. And this also, we also look at the future prospects, yeah, future prospects in reference to the industry and also in reference to the business itself, right? Very, very important for us to be able to look at that, be able to look at that. The other one that we look at is on the request for loans, and here is the bank, yeah, that commissions the investigation because they would wish to give loans, right? And for them to give out loans, they will need to understand more about the client, and therefore, bank in wishing to give loans may require certain information from the applicant, right? And the bank may want to know, for example, the purpose of which the loan is required, right? Because probably most of the time, the purpose that the client may give when they are applying the loan may not be the actual purpose of taking the loan. The other thing is that you want to know the adequacy of that purpose to the amount being sought, so that you don't just sort, the client to not be sorting 20%, seeking out 20% of the total cost of the purpose for which they are seeking out money, unless they've got the other 80%, right? And therefore, it is important for the bank to know those details. It is important for the bank to know those details, and therefore there are things that they will look at, whether in general the size of the company, the size of the existing market, viability of their concern, right? They may also want to know the extent with which promoters can match the requested finance, right? If they were to go that way, they also want to know the past successes or failures of the business. They also want to know the ability of the business to provide references to their commercial acumen, honesty, integrity in business dealings, right? This would be very, very important. It would be very, very important for the bank to do that, for them to be able to get the accurate data. The other type of audit is what we call fraud investigation. The other type of audit investigation is what we call fraud investigation. And the nature and the scope of fraud investigation are dependent on the instructions that have been given by the client, right? Main challenges usually are that the past time period that needs to be investigated, because this could be a few days, it could be a number of years, right? Then we also have the scope of investigation. We have the scope, because you have to determine whether we are investigating an individual, whether we are investigating the whole company, a whole department, or a group of companies for that matter. Then we must also be able to appreciate the fact that you also have a challenge in the questioning of individuals, because it can be a very painful exercise, which the investigator needs to be very careful on, for them to be able to get quality information from the parties being investigated. Some of the precautions here, when you are seeking information or questioning individuals, that the questioner, the one questioning or the investigator should have a colleague present. Don't just want to go alone and you're questioning this person alone, right? Number two is that the person being interviewed should be allowed to have a friend present, right? For them to be comfortable in the information that they are sharing, and to ensure that they are not pushed into a corner and give false information. Number three is that accusations should not be made, should not make accusation as an investigator, but the availing evidence should be presented and explanation requested, right? Avail the information that you have to them, right? And let them respond to that such information. The other thing is that the questioning should be in private, right? You don't want to publicize that. You don't want to put it on Twitter, right? Or on other media platform. It should be private. It should be sensitive to their needs. Those are some of the etiquettes, some of the things that you need to look out for, irrespective of the type or category of the fraud investigation. Now, we may have two types of fraud investigation, and one is fraud involving the manipulation of records, and the other one is a fraud by employees involving theft, right? Fraud by employees involving theft. Now, some of the things, and some of the processes that you'll be required to follow, yeah, when you're doing an audit investigation, are as follows. One, you have to ascertain the level of authority and the nature of duties of the defaulting employee, right? You must be able to get the level of authority of that employee. And number two, you must be able to cast and watch the cash book and obtain certificate of opening and closing balances from the bank. Very, very important. You don't rely on the ones that you've been given. It is important that you're able to get them, the correct ones. And number three, you may need to check the cash book against the bank statement, do the bank reconciliation, right, for better judgment. You also need to examine the paying slip at the bank and compare with the counterfoil, as this may reveal teaming and lading. It may reveal teaming and learning. Number 5, you need to carry out positive circularization of data, right? Send letters to the debtors, let them confirm their balances at a specific date. Number 6, can scan the cash book for any apparently irregular payment. Right? You go through it, scan through it, and see whether there are any irregular payments. Because most of the time, payments for a business will always be the same, right? At the beginning of the month, you're paying rent. At the beginning of the month, or the end of the month, you're paying salaries, for example. Those are supposed to be consistent, right? Therefore, you must look for the irregular one. Now, confirm that all bad debts that have been written off, and confirm also the discount allowed, the any goods that have been returned, right? It's important to check those items because it is through such items that the fraud come into operation. Any missing voucher, you must be able to obtain duplicates, obtain duplicates. And you should also compare the creditor statement against purchase ledger balances for you to be able to certify that it is true that these are the balances in the purchases ledger. Those are some of the highlights, some of the things that an investigator should look at or should be keen on when they are carrying out what we have called a fraud investigation. A fraud investigation. Now, this is the same for, it should be the same for any other fraud investigation. These are some of the things that are very, very important. Then we also have what we call back duty investigations. Back duty investigations. And this happens where the income authorities have a reason to suspect that a resident individual subject to taxation has not made complete and accurate return of income for tax purposes, right? If KRA, for example, in our case, suspects that you could have failed to pay the right amount of tax, then they can commission what we call a back duty investigation, right? It is ordinarily called back duty investigation. The victim, of course, will be required to appoint his own accountant to carry out the investigation at his own cost, right? And the appointment has to be approved by the income tax department, right? Not everyone can conduct investigation. The any final discrepancy that is revealed must be addressed. If it is a tax that has not been paid, then it means that the tax must be paid. And the income tax authority may require you to pay it with some penalties. For example, if you've not been paying it, you might be required to pay it with some penalties to stand in for the times that time that has been lost, right? And therefore, and remember, this is at your own cost. It is at your own cost. You look for the accountant or investigator and give the names to tax department, KRA, look at them, they may approve, they may not approve. Once they approve, it is at your own cost, right? Therefore, it is always important for us to ensure that things are done correctly to avoid such things happening. Now, we may also have another type of investigation. That's where the accountants report on prospectuses, right? And this type of investigation is when the company wants to go public, for example, when they want to go public, and some information is required. Now, the title of the report identification of the reporting accountants is key, because must be able to give details of their addresses, right? Must be given details of the addresses, and you may require past accounts require past accounts, which must be prepared in accordance with the generally acceptable accounting practices. And the accountants, whether the accountants need to also establish whether the accountants have made up any submission to the members subsequent to the previous balance sheet audit. Opinion on truth and fairness of the account must be observed. Significant accounting policies that have been used in preparation must be highlighted, right? Profit and loss for the last 5 years must show earnings per share, profit before tax, taxation and extraordinary items. We also have what we call capital commitment and contingencies, not provided for. And of course, the report must have a date. It must be signed. It must be signed. You also have what we call prospective, report on prospective financial information, and this may be commissioned by potential investors who want to probably invest in a business, and therefore they would want to understand more about it. They would want to understand the performance, both past, present, and get a projection of the future. And therefore, it is important for us to be able to understand the details concerning that. The other one that we need to look at, of course, where we are still at it, we must write the report in conformity with the requirement of our client, right? Titles, addresses, identification of prospective financial information must be there. We must look at the disclosures therein, letters of consent, comfort letters. All this must be done. Then we also have another investigation. What type of investigation? We call it investigation by the registrar of the companies. And as we had seen, this one is under section 164 to 175 of the Kenya's Companies Act. And we say that it is commissioned by the registrar who may want to understand the way the company is operating. And therefore, the auditors, the registrar must appoint inspectors if the company, by resolution or by court order, right? And then must be able to declare that the company affairs should be investigated. Now, section 166 empowers the High Court to appoint inspectors if it appears that their circumstances suggesting so. That is under section 166. And the same section gives the inspectors power to investigate the affairs of investigated companies holding or any subsidiary that they may have if they consider it relevant to their inquiries. Right? They consider that relevant to their inquiries. You also have a different set of procedures for bankruptcy and the duties of the liquidators, powers of the liquidator, which are very important for us to be able to look at. So we can continue here and look at the issues of the receivership, and usually this is given as a remedy for the debenture holders and the creditors. When the company is not able to meet the obligation of paying up debts as and when they fall due, then the courts may appoint a receiver, right? The courts may appoint a receiver. And again, also, you can also view it from the fact, from the angle that the debenture holders may wish to release their security and recover their money, and may make use of all or any of the following remedies, right? They may make use of either one of the following remedies or all of them. One, they may sue on behalf of themselves and all other debenture holders to obtain payment or to enforce sale of the security. In this case, the court will appoint a receiver and a manager for the company's business. Then declare the debentures to be a charge on assets of the company, and order, of course, for the sale of the property. But two, may appoint a receiver. The conditions of the issue of the debenture given or has given them power to do so, and therefore the debenture holders may appoint a receiver on their own. The receiver will sell the property, and the sale and the proceeds will be utilized for the payment of the principal sum, any interest that has accrued, and the cost that is due to the debenture holders. And the other options is they may apply to the courts for the foreclosure of the company's right to redeem the debenture. And this remedy, of course, is not common, as it is necessary for all the debenture holders of every class to be parties to the court action. Therefore, they do it as a whole, the entire debenture holder class of shares. And therefore, it is not unique to just one debenture holder. Now, again, the debenture holders may, as a creditor for the principal and the interest thereon, present a petition for the winding up of the company. And if there is a winding up in progress, you can prove in the winding up for the amount due to him, but not having any security. And therefore you will rank merely in the ordinary creditors. You may also have the property sold by the trustees if the debenture trust deed permits the sale, right? And therefore the debenture holders has many options, as we can see. He has many options that, as we can see. And how is the appointment done for the receiver? Now, a debenture holder can appoint a receiver under the express power in his debenture or in the indenture. That is, if the document that they signed gives them power. Alternatively, they can apply to the courts, right? Now, under the section 347, the courts have power to appoint a receiver on application of a debenture holder or any other creditor. And therefore, a receiver will be appointed by the courts if the principal sum becomes due, right? Number two, if default is made in the payment of the principal and interest. Number three, if the company is being wound up or the winding up is imminent, right? Number four, if the company is disposing of its undertaking in violation of the terms of the security. Number five, if there are judgment against the company. And number six, if the security is in jeopardy or in danger of loss or serious deterioration in value. Those circumstances will force the courts to appoint a receiver. We also look at the issues of bankruptcy and insolvency. Now, bankruptcy is a legal status which a person and not a company acquires when the court makes an adjudication order against them, right? It's a legal status which a person acquires, and here it is not a company. When the court makes an adjudication order against them, the order effectively deprives him of the ownership of all of his property. course, with certain exceptions, which are very few, subject to the courts. Now, insolvency, on the other hand, refers to the inability of a person, including a company, to pay the debts, the inability to pay the debts as and when they fall due. However, although a debtor may be insolvent, he is not bankrupt until and unless the court adjudges him to be so. And therefore, it is important for us to be able to differentiate those two, bankruptcy and insolvency. Now, what are the objects of bankruptcy law? Now, the principal object of the law, bankruptcy law, relating or the law relating to bankruptcy is as follows. One is to ensure that the debtor property is distributed equally amongst his creditors, right? Because you have many creditors. There's no one creditor who will wish not to be paid, and therefore it must be distributed in a fair manner, in an equitable manner against all of them, right? And if the court agrees also, is able to grant a discharge, they are able to grant what we call a discharge. We are able to grant a discharge. We are able to grant a discharge, thereby freeing him from any other further liabilities for the past debt. And number three is to examine the debtor in order to see if he has committed any offense and to punish him in the appropriate circumstances, right? And to punish him in the appropriate circumstances. Need to take that should mark the end of my presentation. We head over to the discussion forum and continue our interaction there. Thank you.